Okay, so thanks guys for joining today. This is part 4 of our webcast. Actually, no, I believe this is part 5, where we're now ready to build out the balance sheet. So what we had done up to this point is we had built out the income statement. From the income statement, we had laid out, we still have the interest to go, we had laid out the cash flow statement, or really as much as the cash flow statement that we could have built at this point. And then we realized here that there are major holes to the cash flow statement, namely the depreciation, the deferred income taxes, and the working capital. Really almost everything in the operating activity section. So we had said the really better next step, although the balance sheet is the third statement that we want to build, we really can't, it wouldn't really be as appropriate to build that until we have filled out a little more of the cash flow statement. In other words, we need to start looking to these supporting schedules, the depreciation schedule and the working capital schedule. And we built out depreciation. We linked up straight line depreciation into the income statement and into the cash flow statement. Then we built accelerated depreciation as a means to create our deferred tax liability. That we pulled into the cash flow statement. And now we have a little bit more of a cash flow statement. We still have two things left empty aside from the balance sheet, but we have the interest expense, interest income from the income statement. We have the short-term and long-term debt from the financing activities, and both of these empty lines, or all of these empty lines, will come from the debt schedule. Okay, so the next thing is, and the debt schedule, as a side note, is the last statement you ever want to build. You always want to save the debt schedule for last. So what we want to do now is we want to look at the balance sheet. And I want to talk about, again, I want to save much of the conceptual as per your feedback from last year. But what I do want to do is I want to talk a little bit about the way this model is being built and how we're thinking about projecting the balance sheet, really because there's two ways to build a model. You can build one where you have the cash flow driving the balance sheet, or you can build one where the balance sheet drives the cash flow statement. And really, I've seen it done both ways. At Morgan Stanley, though, I saw more often the cash flow drives the balance sheet, but let me explain both. And so really what this means is the balance sheet driving the cash flow statement means you build the income statement, you build the balance sheet, and then you back into the cash flow statement by subtracting year-over-year balance sheet items. So that's taking the income statement, taking the balance sheet, and backing into the cash flow statement. The other method is you build the income statement, you build the cash flow statement, and then the balance sheet is driven off of the cash flow statement, meaning the balance sheet, or the implication is, balance sheet line items move by how cash is spent or sourced. And this is the way we've done it more often at Morgan Stanley. I mean, really, in reality, it depends on the information that you're given. So if you're dealing with a client model, for example, and they give you an income statement and a balance sheet, and you don't have a cash flow statement, well, then you got to do it the other way. You know, let me give you a good example. So like in private equity, for example, private equity, you're dealing with private companies, and if it's a private company that doesn't have SEC requirements, then usually you're given income statement and balance sheet information, not cash flow statement information. And I'm saying that because if you don't have SEC requirements and your requirements are just for tax purposes, the IRS requires a statement of income and a statement of balances. They don't really require a cash flow statement. So a lot of times in private equity, if you're dealing with private businesses, you might not have a cash flow statement, and then you're forced to do the income statement, the balance sheet drives the cash flow statement method. If you have a choice, I recommend the cash flow statement driving the balance sheet method for two very good reasons. One, it's more intuitive, okay? So the intuition, and again, we're not really focusing on concepts in this webcast series, but the intuition is you build the statement of income, and then really the investor kind of wants to say, okay, well, if you've generated $4,000 in profit, or here $4 million in profit, how much of that was real? How much of that was tangible? That's what the cash flow statement sets out to do. The cash flow statement, really the cash flow operation, sets out to say, okay, of this $4 million in income, how much of that income was really received in cash? That's why from an investor's perspective, the investor really cares about the cash flow statement. That's why we have a discounted cash flow analysis, not a discounted net income analysis. Discounted cash because to an investor, cash is really what the company's producing. So it's intuitive to start with the income statement, then go to the cash flow statement, and then go to the balance sheet. That's the reason why, that's the number one reason why I prefer cash flow statement drives the balance sheet. The second reason is the balance sheet driving the cash flow statement, you're really plugging or solving for cash flows. And that might cause error or overlooking some cash flows that would have been there if you did it the other way. And I'm going to give you a great example. Let's look at PP&E. Okay, PP&E, or property, plant, and equipment, is mainly driven by two things. Okay, it's mainly driven by CapEx and depreciation. So your property, the property that you own, is increased by capital expenditures. Capital expenditures is the money spent to build that property. So if you have capital expenditures or money spent, that's going to increase your property balance. Your property decreases by depreciation. Depreciation is the aging of assets. So your PP&E moves by your CapEx, cash flow line item, and your depreciation, also a cash flow line item. So let's say we have a balance sheet that has 2016 PP&E of $1 million, okay? And then 2017 PP&E of $1,500. Okay, let's say we have a model, and our model has an income statement, has a balance sheet, and we know we have to use the balance sheet to back into the cash flow statement. So if we see PP&E in 2016 of $1 million, and then PP&E in 2017 of $1 million, the idea of the balance sheet driving the cash flow method is we can subtract 2016 from 2017 to give us an indicator as to what the cash flow will be. But there's a problem. Problem is, I don't know. The problem is this could mean, if I'm using this to back into the cash flow statement, this could mean I have CapEx of 500. Right? This could mean I have CapEx on my cash flow statement of 500 because 500, and it's negative in the cash flow statement because it's a cash outflow, and we'll talk about that. CapEx is always negative. If I've spent 500 in 2017, that means my property's gone up. But the problem with the balance sheet driving the cash flow method is I don't know if this is correct. Or could it have been that my CapEx was 600, but I had depreciation of 100? Right? Because what this is saying is, well, my property went up by 600, so my property is 1,600, but then depreciation brought my property down. My point is this: when you're going from when you're using the balance sheet drives the cash flow method, you might be missing some cash flows. On the other hand, if you're using the cash flow statement drives the balance sheet, the cash flows are there, and you're going to use each and every cash flow to drive the balance sheet line item. This is an overly simple example, but to illustrate a very important point. So I see a lot of people send me emails about, oh, I'm working in XYZ private equity firm, and I'm doing the balance sheet drives the cash flow method. Why did you recommend it the other way? And so this is why. Obviously, though, if you're in private equity or if you're in somewhere where you don't have a cash flow statement and you're forced to do it this way, then you're going to have to do it this way. But in Morgan Stanley in the bulge bracket banking, when we had the opportunity to choose, we did the income statement, cash flow statement, balance sheet. Again, this is a crude example because in reality I could have went to a depreciation schedule and looked up what these items are, but there are a lot of examples where there are line items that wouldn't be captured in other tables, and you're really plugging if you use the balance sheet drives the cash flow method. So my point is this: I prefer the cash flow drives the balance sheet, and the idea of the cash flow drives the balance sheet is each line item in the cash flow statement drives the balance sheet line item. When you look at every single line item in the cash flow statement, you should be also thinking about how did this cash inflow or outflow impact the balance sheet line item? Because each and every cash flow line item must drive the balance sheet in some way. And so there is one other very important reason why I believe cash flow drives the balance sheet is the right way to build the model. And it is, if you understand the concepts, and again, and importantly, the major concept indicating that each and every single cash flow statement must impact the balance sheet in some way. This is step one towards the conceptual understanding of building a balance sheet, and step one towards what I mentioned in the last class, the idea behind A proper conceptual understanding of the balance sheet will prove that if you understand how a balance sheet is built conceptually, which really isn't taught that often, I will guarantee there is a system for being able to balance any balance sheet that might be unbalanced in 30 minutes or less. It all comes from the understanding of how a balance sheet is put together, and fundamentally the understanding that each balance sheet line item is driven by the cash flow line items. And I guarantee you this is a foolproof method, because this is the plight of an analyst. That's an analyst that stays up all night struggling to balance an unbalanced balance sheet, and 90% of the time the problem is they just don't have a proper conceptual understanding. I'm going to give you that understanding now, and it falls upon the idea that the cash flow drives the balance sheet. Assets, liabilities, and equity are each and every time driven by how cash is spent or sourced. For example, if there's a cash outflow, that could mean that an asset is being created. Think about property. Think about buying property. If you're spending cash, you could be spending cash on building property. If you want to build property, you spend cash to build property. Look at CapEx and PP&E. CapEx is money being spent to build out your property, plant, and equipment. If you buy an asset, cash is spent, the asset goes up. The opposite happens if you sell an asset. If you sell an asset, assets go down, cash goes up. Again, going back to assets are driven by how cash is spent or sourced. So let's look at the model and look at this step by step. In the model, what I want to do is I want to go to each and every balance sheet line item, and I want to ask myself two questions. One, what cash flow statement line item drives this balance sheet line item? That's number one. Number two, in what direction does cash drive this? Because it could go either way. So for example, with the PP&E and CapEx, CapEx drives PP&E. What direction? Well, cash spent builds your property. So a cash outflow means increase in PP&E. This is the ideal way to build the balance sheet, is going line by line to each balance sheet line item and asking yourself two different questions. Which cash flow statement line item drives the balance sheet line item, and in what direction? And it might be that there is no cash flow statement line item that drives the balance sheet line item. That could happen, which means the balance sheet line item shouldn't change at all. It should stay flat. If there is no cash being spent or generated for a specific balance sheet line item, then that line item is not going to change at all. That's the way you'd think about this. So let's start with cash. Cash and cash equivalents. Which cash flow statement line item drives cash and cash equivalents? Well, it's going to obviously be on the cash flow statement, changes in cash and cash equivalents. That's question number one. Question number two, in what direction does it change it? So if you think about it, if I've generated in 2012, this is basically saying I've generated $3.9 million in cash. Well, if I've generated $3.9 million in cash, then my cash balance should go up. Cash should increase cash. So the answer to question number two is this should be increased by the $3.9 million. So what's the formula for that? So the formula is 2012 cash should equal 2011 cash plus the cash generated in this particular year, which is identified by the 3.981. Okay. 2012 cash, oops, I made a little typo here. 2012 cash equals 2011 cash plus the change in cash and cash equivalents from the cash flow statement. That's the idea. Okay? Let's look at the next one, accounts receivables. Two questions. One, which cash flow statement line item drives accounts receivables? Well, I'll tell you right now, it's changes in accounts receivable. Pretty obvious, right? You'll get familiar with what drives what. Changes in accounts receivable. Question number two, which direction does it drive accounts receivable? Well, let's think about it. We talked about this when we built the working capital schedule. If these accounts receivables were going down, okay, accounts receivables are the money owed to you, to the company, by the customer. If the AR is going down, that means you're collecting money from the customer. That means the customer has paid you, so that accounts receivable is going away. So if AR is going down, that means you're collecting from the customer. If AR is going down, that means you're generating cash. Cash up, AR down. Think about it the opposite way. If AR is going up, that means cash is going out then. Okay? So question number one, which cash flow statement line item drives this? It's changes in accounts receivable, right here. And if I see a negative, if I see cash going out, that means AR should be going up based on what I just discussed. So the formula should be this. Number one equals, you always start with the balance from the year before. And the question is it plus or minus? Well, if it was plus, that would mean, if I did plus 67, that would mean the AR balance is going down. But I just analyzed it should be going up. So it shouldn't be plus. It should be minus. So this is going to be equal to the year before minus 67.6. You see what we're doing is it's a double negative. It's minus negative 67.6, meaning it's going to ultimately increase my balance. And it does. It goes up by 67.6. This should make intuitive sense. AR goes up means cash is going out. Easier to understand it the other way. If AR goes down, that means cash is coming in because you're collecting on the accounts receivables. Okay? AR is one of those tricky things. A little bit difficult to think through. It's more intuitive with inventory, though. Let's talk about inventory. Okay? Inventory is a little bit more intuitive because inventory is like property that you buy. If inventory is going up, that means you're buying property. That means you're spending cash. Inventory goes up, you're spending money. If inventory is going down, that means you're selling the property. Cash goes up. Right? Same movement as the AR. It's AR up, cash down. AR down, cash up. Inventory up, cash down. Inventory down, cash up. Right? Same idea. But it makes a little bit more intuitive sense with inventory. And again, buying property, right? You spend money to get the property. You sell the property goes away, cash goes up. You got cash because you sold the property. So, question number one, which cash flow statement line item drives the inventory? Very simple, changes in inventory. Number two, which direction does it drive it? Well, if the cash is going out, I'm spending money, my inventory should be going up. So I'm going to do equal inventory from the year before minus. Minus. Why minus? Because if I do minus, then it's going to be minus negative 18. It's going to be double negative. It's going to effectively increase my balance. And guess what? Look at the pattern here. You're going to start to see a pattern in the formula. The pattern of formula is, it always starts with the balance sheet line item from the year before equals F8, equals F9, equals F10. It's always the line item from the year before plus or minus the cash flow statement change. So number one, if you have a good, intuitive, conceptual sense of how a balance sheet is built, if you're building a balance sheet with a similar structure and formula, if you're building it in this clean way, that's one major step towards building a balance sheet that will stay in balance. And number two, it's the conceptual understanding of what's going on in here. Because the structure and formula is the same, it helps you with the concepts. Now, I know that there are other ways to build these formulas. You can build this from other schedules in the balance sheet, but I urge you to realize that if we are building this with the same simple structure of formula, it's that understanding, the conceptual understanding of avoiding an unbalanced balance sheet. You'll also notice this. I said plus or minus, right? I said that the structure in the formula is it's always the first term, F8, F9, F10, plus or minus the cash flow change. Well, guess what? In every asset line item, it's always going to be minus, except for cash, okay? It's always going to be minus for every other asset because of the relationship between cash and asset. Asset up, cash down. Asset down, cash up. The only exception to that in the asset side is cash, because cash up on the balance sheet means cash up in the cash flow statement. That's the only exception. Everything else in the middle is minus. You will start to see one of the biggest reasons for a model to be out of balance is something off about that formula, that structure and formula. You're using a plus when you should be using a minus, or you're using a minus where you should be using a plus. Building a formula in this manner helps you avoid that. One of the second more common problems, and we'll overview this once we have the balance sheet done, is there's a line item in the cash flow statement that you forgot to link into the balance sheet. The model stays in balance when each and every cash flow statement line item drives the balance sheet. So this is why I strongly recommend, as we build this, to somehow mark off each cash flow statement line item as we're doing it to indicate that we've used that line item. So let's do that. Okay, so what did we use so far? We used total change in cash equivalents. I'm going to mark it by highlighting it red. We used changes in accounts receivable. We used changes in inventory. By the time we're done building the balance sheet, I want to see each and every cash statement line item marked off once and only one time. This is the foolproof method. Guaranteed, if you go through this, even if the model that you built is from a client who has 100 line items, this is the way you can foolproof in 30 minutes. Detecting what's wrong with the balance sheet. And I'll go through it further once we've built this completely. Prepaid expenses. Question number one, which line item drives prepaid expenses? It's changes in prepaid expenses. Which direction? Well, based on what I just said, it's a minus. It's always a minus in the cash flow statement except for cash. Always a minus. So I'm going to say equals line item from the year before minus cash flow statement, changes in prepaid expenses. Start to get the structure and formula. Other current assets, same idea. Changes in other current assets equals line item from the year before minus changes in other current assets. Okay, so we're done with other current assets. I'm going to add things up and down. I'm going to highlight what we've used so far. I'm going to pause for a minute or two to have you guys get caught up. If you want to look at one of these formulas, let me know. I'll just put the cursor over this so you can see. I'm going to pause for 1 or 2 minutes so you guys can get caught up. Think about what I've said. Okay, guys, let's continue. Property, plant, and equipment. Property, plant, and equipment is driven from two things, as I mentioned before, CapEx and depreciation. So there could be more than one line item that goes into a balance sheet line item. There can be. But you cannot double count. You cannot use the same cash flow line item into two different places in the balance sheet. That would cause a balancing error. So, property, plant, and equipment equals property, plant, and equipment from the year before. Which two line items drive the property, plant, and equipment? CapEx and depreciation. In what direction? We use the minus. Always a minus. So this is equal to F14 minus cash flow statement CapEx minus depreciation. Okay? I'm going to mark off that I've utilized depreciation. Okay? I'm going to mark off that I've utilized CapEx. Okay? Goodwill is 0. If you took the time to look through this, you'll realize there is no cash flow statement line item that is called changes in goodwill or that impacts goodwill. So if there's no line item that changes this line item, it will stay flat. Effectively equal to line item from the year before plus 0 change. Okay? Same thing with this identifiable intangible assets. It's 0. Keep it flat. Pension assets. We can go in and look for line items that relate to pension. There's nothing there. If there's nothing there, it won't go to zero. If there's nothing there, it stays flat. It remains unchanged. Deferred tax assets stays at zero. Remember, we have a deferred taxes line item, but we talked about a deferred tax liability, not an asset. If you want to know the difference, it's in the book. Other long-term assets, again, nothing really identifiable for that. Let's keep it at flat. Okay. Total everything, including the total current assets. And we can then continue to liabilities. Okay. Accounts payable, we're now on the liability side. Liabilities might be a little different. Okay, number one, which cash flow statement line item drives accounts payable? Changes in accounts payable. What direction? Well, if a liability goes up, that means cash is going up. Different than an asset. Remember, asset was asset up, cash down. Here, liability up, cash up. Think about a loan. If you were going to take a loan, you would get money, right? Cash would come in. You'd also get a liability. The liability would go up. How about the other way? Think about paying back a loan. If you were to pay back a loan, the liability would go down and the cash would go down. So that means and that's true for every liability. So that means for accounts payable, this is going to be equal to the year before, plus. It's a plus, not a minus. In other words, changes in accounts payable is 13.2, meaning our accounts payable balance should go up by 13.2, and it will if we had put a plus in, plus. Accrued salaries. Accrued salaries is line item from the year before, plus changes in accrued salaries. So again, getting back to the structure and formula, it's actually always term from the year before plus the respective cash flow statement line item, except for assets that are not cash. Everything else, it's a plus. Liabilities is a plus. Even shareholders' equity is a plus. Very simple. Short-term debt equals short-term debt from the year before plus changes in short-term debt. Now, we didn't link this in yet, but still, build the formula. Once this is done, everything will flow. Other current liabilities. Line item from the year before plus changes in other current liabilities. Okay. Sum everything up, you should get 104.7.5. I want to highlight what I utilized already. I utilized accounts payable, accrued expenses, other accrued liabilities. I also used short-term debt. Okay, take a minute or two. Get caught up. Let me know if you have questions. So guys, the goal here is talking about how depreciation schedule, debt schedule is built. You know, I am going relatively quickly in terms of some people might be thinking, well, how do you know what goes where? You know, and I kind of, that's a conceptual question. There's a lot of things that are a given. You got to memorize all the time. For example, PP&E is driven by CapEx and depreciation. You just got to memorize that. Cash is driven by cash. As you practice with these more, you'll gain some familiarity with that. I do give a lot more color on that in the book, and actually, if you're good with the modeling, I recommend buying the first book because it goes through the whole thing again, building a model at Walmart step by step, so you'll get more practice. And I recommend you practicing on your own, and you'll slowly get it. We do a deeper dive where we answer that question. When we do like a real company that might have 20 different line items that are kind of one-off, how do you narrow down and tell what goes where? But again, for the template, this is as far as I want to go. Long-term debt, let's continue. Long-term debt, changes in long-term debt. This equals to line item from the year before plus cash flow statement, changes in long-term debt. Okay. Deferred tax liability, Gurpreet had this question, equals line item from the year before plus deferred taxes. Deferred taxes drive deferred taxes. Pensions and other, these are one-off line items. If you kind of went line by line, and if we went this together, we'd realize there's really no line item that refers to pensions, so it will remain unchanged. Same thing with other. You'll find that a lot. There's a lot of line items that just stay flat. Total liabilities is a sum of everything above. Don't forget to include the current liabilities in that total. So what I'm going to do is I'm going to just highlight what we utilized so far. We utilized deferred income taxes. We utilized long-term debts. We utilized, I think everything else stayed flat, right? Everything else stayed flat. Okay. Okay. Stockholders' equity. Operates the same way at liabilities. Let me explain. Let's say we're raising stock. Stockholders, we're raising stock. We want to do an equity offering. If we raise stock, stock's number is going to go up, more stock in the market, and we're going to get cash. We as the company, we're going to get cash. Okay? So this is just like a liability, right? Liability up, cash up. So the term in the middle is a plus. It's always a plus. So if our preferred stock equals preferred stock from the year before plus changes in preferred stock. Do we have a change? Here we go. Issuance of preferred stock. Okay. Common stock is common stock from the year before plus cash flow statement, issuance of common stock. Treasury stock. Treasury stock is stock bought back. Same idea. Item from the year before plus cash flow statement, treasury stock. Okay. Accumulated other comprehensive loss is 0. We'll keep it at 0. Retained earnings is another one you kind of have to memorize. Retained earnings is driven by two things, net income and distributions. Retained earnings is the income that's generated in the business that stays in the business. It's the income after you've paid out your distributions to equity holders, mainly dividends and non-controlling interests. So it is retained earnings from the year before plus net income plus dividends plus non-controlling interests. It's your net income after your payouts. Okay? And let me highlight. So we've used dividends. We've used non-controlling interests. We've used net income. I believe we used everything. Okay? Oh, yeah. And we did common stock, deferred stock, treasury stock. Okay. So everything is highlighted. I'm not going to, the ones that are zeros, these are placeholders. If they're zeros, they're not going to make any differences. But everything of value has been utilized once and only one time in the balance sheet. The balance sheet must balance. I hope, fingers crossed, unless I made a mistake. Okay? I'm going to add everything up. Okay? And the liabilities and stockholders' equity is the stockholders' equity plus the liabilities. That should match the assets as per the formula, and it does. So we're balancing. Okay? Once you have a balancing balance sheet, highlight the row. You can highlight the row by using the mouse or by holding the shift button and tapping the up arrow. Okay? And then while still holding the shift button, tap the right arrow. And then do a big Control R, copy right. And the whole model balances. Now, very important. If you understand the concepts, and I recommend to watch this a couple times, if you understand the concepts, you should understand, and if you understand the importance of building a model this way, you can understand how a model becomes imbalanced. And you will understand there are only 4 possible reasons why a model will be out of balance. And those 4 possible reasons are, number 1, and it's right in the slides here. There's a line item in the cash flow statement that has not been linked to the balance sheet. In other words, this is why I recommend highlighting things. If you've gone through the whole process and realized there is a value that you didn't highlight, meaning there is a value that you did not link it to the balance sheet, your balance sheet would be out of balance. So for example, if I didn't link up the deferred taxes properly, if I just kept it flat, my balance sheet would be out of balance. I said, okay, why is it out of balance? And I go here and say, oh, I didn't highlight this. I didn't use this. That's why it's out of balance. That's problem number 1. Line item in the cash statement has not been linked. So it's very important to check the cash flow statement line items off as you go along and utilize them. 2, there's an item in the cash flow statement that's been linked in 2 separate places in the balance sheet. Very common error. In other words, I went down to deferred income taxes and I linked it up into the deferred tax liabilities appropriately. But maybe for whatever reason, I had also linked it up into deferred tax assets. So the same cash flow statement line item I used twice in the balance sheet. Can't do it. Cash flow statement line item should be used in the balance sheet once and only one time. Again, this is why it's very important that you check things off as you go along to avoid double counting. So in other words, if I had linked deferred taxes into deferred tax assets, and then I got to the deferred tax liabilities, I said, oh, deferred taxes could go there, and it's highlighted, and I said, oh, I already used it. It would avoid this type 2 problem. Line item in the cash statement has been linked in 2 places. Very common error. Third possibility for something to be wrong is the right line item is linked in. So in other words, okay, well, deferred taxes is linked in to the deferred taxes, but maybe it's going the wrong way. This is why it's very important to use the cash flow drives the balance sheet method, and it's very important to use the same structure and formula. I always see analysts say, oh, well, I could pull this from here, or I could pull this from here, I could pull this easier. Why do this formula? Because it avoids a problem of type 3. The structure and formula, if you build it clean and consistent, it's a more error-proof formula. In other words, the problem of type 3 means you've confused your pluses and minuses. The asset was increasing when it should have been decreasing, or it was decreasing when it should have been increasing. Proven by plus and minus structure and formula. There is a possible 4th error. There is a possible error where your model is built right, the formulas are right, you're using the pluses and the minuses in the right way, you've used each and every cash statement line item once and only one time, but it still doesn't balance. If you face that, that means there's an error in your totals. There's a totaling error, meaning, I see this mistake a lot, your cash and cash equivalents is adding wrong. It's just adding this and then not this. Or maybe your operating activities is adding wrong. It's adding all these and not this. Or maybe on your balance sheet, the totals are wrong. It's a very common error. If you think about the way a balance sheet stays in balance, those are the only possible problems you can ever have with a balance sheet. And if you know that, I guarantee you, if you have a broken balance sheet, it will never take you more than 30 minutes. Analysts in bulge bracket bank, they stay up all night. They stay up all night because they're not thinking about the model conceptually. And if there's a problem with the balance sheet, they're like this. They go up here and they look in here. They see, maybe I can catch something. And they go to the right instead of going down. And they're like this. And it's 2 o'clock in the morning and you're getting tired. And you go to the next one. And you stop to forget it. You forget what you're doing. You forget and you go get a coffee and you come back and you go here. And you spend all night. There is a foolproof way of balancing an unbalanced balance sheet. Knowing what I just told you. And I'm going to go through that foolproof method right now. If you've ever faced an unbalanced balance sheet, let's say there's a problem here, okay? And so your balance sheet is out of balance, okay? This is what I recommend doing. Step 1. Go to the slide. Step 1. Create a temporary differences column on the balance sheet. In other words, you'll always have a situation where one column is out of balance, but the preceding column balances. If the hard codes don't balance, then you have a problem with your inputs. Go back to the annual report. The annual report must balance. If it doesn't, then you've typed things in wrong. But delete everything after the first unbalanced year. Once this balances, okay, then you can just copy everything to the right again. So I'm going to delete everything and focus on just one column. That's trick number 1. I don't know why analysts tend to look at this and go to the right. Focus on one column. Once that column is balancing, copy to the right. Create a differences column. Okay? And then subtract this year from last year. I don't care which way you're subtracting. Just subtract. Copy down. You don't have to do this with me. You can just watch and then watch the recording. Guess what? These are cash flows. The cash flows are the changes. Create a differences column. That's step 2. Sorry, that's step 1. And then for each line item in the differences column, ask the same 2 questions you asked when building the model. 1, which cash flow statement line item should drive this balance sheet line item, and do the numbers match? Because if the numbers match, that means we're pulling the right line item. And 2, is it going the right way? So for example, which cash flow statement line item drives cash and cash equivalents? Obviously, changes in cash and cash equivalents. So, and what direction is it going? It's going up. So the difference is as 3981.1. Cash has gone up by 3981.1. Meaning in my model, I should see plus 3981.1 in the cash flow statement. And I do. So this link is fine. And I'm going to highlight this, let's say a different color to indicate I've checked that line. Next, accounts receivable. Accounts receivable is going up by 67.6. Remember, when AR goes up, that means cash should go down. So I should see minus 67.6 in changes in accounts receivable on the cash flow statement. Do I? I do. So that's working. Next, inventory is going down by 18.5. A reduction in inventory means I should see plus 18.5 in changes in inventory in the cash flow statement. Do I? No. I see minus 18.5. Something's wrong. Let me look at the balance sheet. Let me go in there. Oh, what do I see here? It's a plus. It should always be a minus. I found one of the problems. Let's check it again. Now this is going up by 18.5, so I should see minus 18.5, and I do. This is right. This is the process. And so on. And when you get to the bottom of this, if you're doing it in the way that I mentioned to you, each of these should be highlighted yellow once and only one time. Now you know. You will absolutely know what's wrong with the model. If you've gone through this whole check process and you're at the bottom and you've realized there are line items that you didn't highlight, then you've detected a problem of type 1. You've identified a line item in the cash flow statement that had not been linked to the balance sheet. If you're going through the differences process and you've highlighted a line item and you've seen that it's been highlighted again, they mean, in other words, it's been linked twice. You've identified a problem of type 2. A line in the cash flow statement that's been linked in 2 places. If you've gone through and you realize the numbers didn't match, or the numbers were increasing when it should have been decreasing, or vice versa, just like a problem we just detected, we just uncovered a problem of type 3. The line item is driving the cash flow statement, but it's going the wrong way. And then there's a possible fourth. There's a possibility that you've gone through and you've checked out the line item. Each time, one by one, everything is highlighted once and only one time. Everything checks out and it still doesn't balance. If that's the case, then you know there's a totaling error somewhere. That is hands down the only thing that could be wrong with the model. I guarantee you, I've never been not able to solve a model within 30 minutes. And students that go through our program, the same. This is foolproof. And it'll take you far in case studies and things like that. If you come into our school, we go through this, we practice this all week, we go through examples, get you guys experts at this. But it's important to understand the concept. And I can't tell you how powerful this is. Even if you're given a model that's a complete mess. In other words, a model from a company, there's 100 different line items, and it's not built this cleanly. I recommend do it on paper. Print out the cash flow statement, print out the balance sheet, use a calculator, subtract line by line, and mark off with a pencil each and every cash flow statement line item. You can still use this method. I guarantee you it'll be impressive. And it'll make you a better analyst and a better interview candidate, especially if you get to case studies. So I want to stop for questions. I do want to mention, we don't have too many people online, and I do notice there's been a lot of people watching the recordings. I just want to kind of gauge what direction I should go in terms of interest for these model courses. I know they're helpful, but if it's a matter of timing, let me know. If it's a matter of you guys just prefer to watch the recordings, let me know. Feedback would be appreciated so I can kind of get a gauge for if I should keep doing this or not. I can kind of do this every weekend indefinitely. Another note is, because of the Thanksgiving holiday, we're not going to have one next weekend. I'll send a link with the recording talking about having this on the weekend following. And I just want to kind of see if you guys have any questions. Okay. A couple questions. So I'm not going to distribute the PowerPoint because it's basically 150 slides of our book. You can always watch the recording and pause on those slides. Some people are making good points that the time, it might be tough for other people. I do notice there's a lot of people watching the recordings. I just want to gauge if I should continue to do it, if there's a different direction, if it's the material. Just your collective feedback is helpful. So I'm going to start to download this. If you have any other questions, feel free to ask me offline, and hope you found this informative. Thanks.